using margin to fund my business, 12.5K in debt. And what do I mean by this? And how does, this may sound negative, but it's actually not negative in reality. Okay? So, what I have going on is what we like to call margin. Okay? So that's what we like to call. We like to call it a margin. And when you pretty much borrow against your stocks or whatever, you can have a thing called margin for the most part, and that margin is you somewhat using your stocks in terms of liquidity, so you can actually borrow from all these banks or distributors, etc. So basically, let me tell you how this all started. So I took out 12.5K from my stocks, okay? And the reason I did so is because I wanted to use it in order to start a business and help fund certain things that I wanted to get funded, okay? So I'm not going to go more into depth with that, but just know I took out 12.5K. So in my mind, I was trying to figure out how I could take out money from my stocks. That's where the majority of my money is in stocks or crypto. I wanted to take out money from my stocks, in which holds the majority of my money. I didn't want to sell it, right? I didn't want to sell it. I just wanted to pretty much get that money out and still have my stocks, okay? So they can appreciate over time. Because the problem is, if you sell your stocks for cash, you go into certain things. I'm using it's an individual account, so I don't have the same issues as someone with the 401k. I don't have the same issues as someone with the Roth or IRA. But there are still issues when it comes to taxes, right? So you can still get taxed because even if you took out money that doesn't really total up to your initial investment, the fact that you took out money in general will still get taxed, okay? And then even though it's 12.5K, it probably wouldn't be that much, but still I didn't want to get taxed at all, and I didn't want to deal with the whole selling and sending of my assets. And then also I wanted my assets to remain because I get dividends, and then it also appreciates in value over time, just from the stock growth. Okay, so I'm putting you guys on serious game. So hopefully you all are listening up and everything. But this is some serious game. So if you're buying stocks, you need to be able to you need to accumulate a lot of it. Okay. And I'm not a person that says like, oh, stock market is this, stock market is that. I'm not even really a huge fan of the stock market because it's all manipulated this time. But most of everything is manipulated because when you have a certain faction or a group of people who have majority of the wealth, they can buy all these assets and then manipulate these assets by the acquiring of these assets and then the selling of these assets, and that causes those things to fluctuate up and down, right? So when you have those people who are owning that, it can destroy some of the reason that you think something should be happening in the market, but it's not, okay? Because of whatever agenda and whatever situation is funding those companies. So, but it's still important to invest, and that be investing into assets, whatever that be for you, whether that's crypto, stocks, gold, even some vehicles, real estate, whatever that is for you. You got to find what makes sense. But I like the stocks. I like stocks. I like the stock market because they give me certain things. I don't have to overly worry about other issues that can arise from other types of assets. So so basically, you need to invest as much as you can into the stock market, because that money that you're investing, you can still access without having to sell. And that's the major benefit. You can access it without having to sell, and your money can still be working for you while you have the cash. Okay? So an example was, let's look at Fidelity, right? Fidelity offers you the ability to have a margin account. So you will turn your individual stock account to a margin account, meaning that you can borrow against your stocks, right? So they go based upon pretty much, I don't know how they calculate it, but they give you a certain amount of cash that you can actually take out and send it to your bank via the margin. And I'm not sure how they do the calculation, but it's a percentage of your overall stock portfolio. So if you have 100K, you have a lot of room to work with in terms of what you can borrow. If you have 50K, you have some room. I would say as a person, an individual, get to like 50K, 60K, and upwards to really start leveraging the margin. But if you can leverage it at any time. You just have to be smart about the percentage you're taking out. So I like to do like something like I would never take out more than 15% of my overall stock value, right? And my overall stock value is up to you, because you have to think about what happens when the stock market crashes. Is the stock market going to crash 90 or 85%? Most likely not. It may crash half, and then if it crashes half and you took half of your cash, like let's say you got 100,000, you took 50,000 out, you took 60,000 out, and it crashes to that extent or whatever, you can get a margin call. And that margin call, they will sell your assets in order to cover what you borrow. But again, think about it. It's not really a big deal, because you are already going to sell your assets to pay for this situation, whatever that situation may be. So if you get a margin call, it doesn't really matter. It's like, yeah, it is what it is. You probably took out too much and you ended up having to sell your stock, but you didn't have any options to begin with for that money, because all your money is in the stock market. So let's go back to Fidelity. So let's say you have a Fidelity account. You have an individual account that you invest heavily into, S&P 500, QQQ, JP Morgan, SMH, whatever you do, right? And then, you have to enable that account for a margin account. Once you enable that account for a margin account, it should give you access to use margin, okay? And then you can borrow against it. So, I took out 12.5K from my overall stock portfolio, because that's something that I can handle, and not really have to worry about the effects if it crashes, because that's a very small amount to my overall portfolio. So that's what I did, right? And the benefits of doing so is you send out the cash, comes within a couple business days, really easy, and it's right in your account, like super easy. But the benefits are you don't have to pay any taxes, right? Because it's looked at as a loan. So you are getting loaned your money. You're using your money in terms of a way to guarantee your loan, right? Because they can loan you this, and if, let's say, it doesn't work out, the market crashes, they can also sell your assets, so you're good, so you're covered. So you get that loan out, you don't owe any taxes because you're borrowing against it. Like, you owe no taxes at all. You can use that money for whatever you want to use, literally. So but the situation is there's interest on what you borrow. So don't think that it's free money. You do have to pay interest. But where I find it to be, very minuscule is because Fidelity, let's actually talk about specifically Fidelity. So Fidelity, their interest is higher than some other brokerages that you would do a margin from. So it depends on what brokerage you're using to buy your stocks. And you want to look at what their margin interest rate is, right? Fidelity is one of the higher ones. I would suggest to look out there if you haven't started buying stocks yet. Maybe you're new to the market. Just look out for places that have like relatively cheap margin, because you may need it in the future, and it's difficult to transfer your stocks from one brokerage to another. You don't want to deal with the headache, so you're kind of stuck at whichever one you choose. And then once it starts having hundreds of K in there, 500, 600, like you're stuck there. Like it's a hassle to try to move everything to a different brokerage. I mean, it's up to you, but I was just looking for something that has low interest, that's reputable, and things of that nature. Fidelity interest rate is about 11%, and that 11% interest rate is actually a lot, because that's like getting a credit card. I mean, a credit card is 22%, but still, 10%, 11% is a lot of interest. Usually you want to look for something that's like 5, 6, 7. But then you got 11. 11 is a lot, but it's throughout the, it's a year. It's a year, um, and things of that. So, but where it is non-consequential is because you got to think about it. Your stocks are also appreciating in value within that year. So let's say, you know, it's 11% interest rate. So you to break even without, yeah, you're gonna, okay, so it's 11% interest rate, and they're gonna charge you an amount each month for, that you for you to pay back. Because you gotta think about it. You have to pay back what you borrow. So let's say you borrow 12K, it's probably gonna be around maybe $100 a month, right? Something like that to pay. But you do not have to pay that $100 a month. It gets added to your loan total, though, right? So if you don't pay it, it just adds to it because it's interest that you're not paying because you're not paying off your loan. But the thing is, your investments are also increasing. So in a year, like, for me per se, my investments in 1 year went up 60%, literally 60% in 1 year. So if my margin interest rate is 10 to 11% in a year, think about it. That means I don't have to pay back my loan. I don't, because I would never I'm not going to get a margin call. I wouldn't get a margin call unless something catastrophic happened for multiple years, So, and by then it's like, the world's pretty much ending, So what I'm trying to say is like, my investments went up 50%, and my margin interest is 60%. My margin interest rate is 10 to 11%. So overall, my investments went up 50%, right? Because you got to subtract what it went up by the margin interest rate. So overall, it went up, 60%, or 50%, right? Which is still way higher than how much I owe. So that 100 that's getting added over time that I'm not paying back because I don't feel like paying it back. I don't have to pay it back. It doesn't really matter because my investments are amplifying the returns way more than what I'm owing. And it seems crazy, but it's not. You can pay it back at whatever you want, whatever you make the money to pay it back. You can pay it back whenever you want. But you paying it back, all it's doing is you're adding it back to your stock account. So that 5K that you borrowed, that 12K, when you pay that back, it just gets reapplied back to your stocks. Do you understand what I'm saying? So it gets reapplied back into your stock because they didn't sell your stock. Your stocks have not been sold. They just subtracted it. They basically held it, for you to borrow that amount. But your stocks are still there and they're still accumulating value for you over time. And once you do pay it, it just gets added back. Like you didn't lose anything. You may have lost some interest, but did you really lose interest because your stocks was going up? You know what I'm saying? Times 5 than what the interest was owed, right? So, it's like a no-brainer. So what I'm trying to say is you want to accumulate stocks so you can borrow against it. Literally, so you don't have to ever sell them. Because when you sell, it just comes with stuff that you may not want to deal with, and then you're selling your stocks, and you gotta it just comes with stuff that you may not want to deal with. It probably is maybe a little bit safer because you don't have to worry about the whole margin stuff. But if you're taking out 15%, 10% of your portfolio to pay for a business thing, that's very small, and the market literally does like 20% a year. So, but recently been doing way more than that. So think about it, like you're pretty much good. And then if you feel like you want to pay that 50, whatever the monthly charge is at $50 to $100, you can. It's not a problem. It's your account. Let's say 1 month you don't feel like paying it. That's not 1 month you didn't pay. You can pay the next month. That loan amount. No one's gonna ding you. No one's gonna come at you. No one's gonna, you're not gonna get a credit check on your whatever. It's up to you. It's you. You're in control of your own money. Yeah, you're borrowing against it, but you're in control. So hopefully that made a lot of sense to y'all. And go ahead and look into it and see if that's something that you want to partake in. I'm not saying to do that every single time you need money, but when you're making, when you need $12,000 and you don't have 12K just liquid, you just have it in your stock market. Then yeah, instead of selling stocks up for 12K, why don't you just borrow against it? Just borrow against it. The market's gonna go up anyway. It's gonna go up regardless. You're not gonna be losing anything. You know, the money that you're getting charged, whatever, is gonna be nothing. So basically, just look into it, guys, and that is what I did. And hopefully, it inspires someone to look into it and figure out how they can leverage it for themselves. All right, that's it for me. Peace out.